Let's take a look at problem 3-7, which deals with corporate tax liability. Okay, I'll read the problem to you that appears just to the right of my mouse here. The Talley Corporation has taxable income of $365,000 from operations after all operating costs, but before interest charges of $50,000. It's also before dividends received of $15,000, dividends paid of $25,000, and income taxes. And what we need to answer is the following questions. What are the firm's income tax liability and its after-tax income? And what are the company's marginal and average tax rates on taxable income? Okay, well, I've worked some of this ahead of time just to make the illustration go a little bit quicker. So the first thing we'd want to do is write down the income from operations, and that's given above as $365,000. Okay, then the next thing we want to do is back off the interest deduction, and the interest deduction is $50,000. Now, after doing that, we need to consider the dividends received, and here I'll illustrate how I came up with that $4,500. Okay, we'd have to take the $15,000, which is given in the problem right here as dividends received, and we assume that the dividend exclusion takes place, and it's a 70% exclusion because it's a corporation receiving the dividends, and dividends clearly represent what you receive from investing in another corporation. So we'll take out 70% and only record 30% of that as the dividends received. Okay, once we do that, then we can calculate the taxable income. Okay, ignore the background noise, everyone. We'll take it from here. So, income from operations less interest deduction plus the calculation where we had to consider the dividend exclusion, and we come up with taxable income. All right, the next thing we need to calculate is the tax liability. And to use the tax liability, we really need to look at the tax tables. Well, we have taxable income of $319,500. Now, I'll switch the screen so we can look at the tax tables. Okay, now you see that in front of you. Well, if we're in the $100,000 to $335,000 range, then using the information provided in Table 3-6 of our textbook, we would use that number right there. Now, if by chance the textbook gets updated, we can still use this problem as a good illustration, though the table data may change the final answer. Okay, so we know we've got $100,000 to $335,000, right? Yeah, we came in $319, so we're in that range. So we know we need to pay $22,250 plus 39%. On any excess above the base, so any excess over the $100,000. All right, so let's go calculate that. And here's how we do it. We take the $22,250 that we just saw from the tax table, then we take our taxable income, which is in cell D12 above, subtract out $100,000, and take that times 39%. And once we do that, we come up with a tax liability or tax expense of $107,855. And by the way, this would be a tax expense sort of excluding a concept called deferred taxes. Okay? And that's why I think that's why this problem says compute the tax liability, because the accountants, according to GAAP, may have to consider some other things, such as the impact of deferred taxes. But for our purposes, let's call that tax liability and assume it's the same as tax expense. We'll ignore deferred taxes. Okay. From there, then, we can calculate the after-tax income, and all we're doing there is subtracting the tax liability from taxable income, and we come up with an after-tax income or net income of $211,645. Okay, now the last part says what are the company's marginal and average tax rates? Okay, well, that's easy enough to do. Let's do the marginal tax rate, and I'm just going to write it off to the side here. Let me just abbreviate this. Marginal tax rate and I'll just use percentage for rate, and then we'll use the average tax rate. And again, percentage for rate. We'll underline that. And the marginal tax rate is simply that 39% that says what tax do we pay on the last dollar we've paid or the next dollar. I've heard it interpreted both ways, and it's 39% to the left of my mouse. So we'll just jot in 39%. Format that. Where's my percent sign? There it is. And I'm going to format this one as well. Now the average tax rate, what you need to do is take the 107 and divide it by the 319. And we come up with 33%. And by the way, if we carry those out a decimal place, we're at a marginal tax rate of 39.0% and an average tax rate of 33.76 or 33.8, and if you took it off entirely, it would be 34%. And that takes care of problem 3-7. Thanks, everyone.